All right, so the final question on today's episode is from Maria. Maria asks, what are the downsides of investing in property, or are there any downsides investing in property? Hey, what's up? It's Ross Murray. Welcome back to another episode of More Than Money. On this podcast, I have real conversations about lifestyle, money, and business. Sometimes I share interviews with business owners about starting their own business and their journey. Other times we do financial education and informational episodes to help you make smarter decisions with money, just like this one today. So if you're new here, consider subscribing. Now, before we get started on today's episode, just a friendly reminder from our lawyers in order to keep them happy, that in preparing this podcast, myself or any other contributors have not taken into account any particular person's objectives, financial situations, or needs. So, before acting on any of this information, you should consider its relevance to your personal circumstances, and if required, seek the assistance of a licensed professional. So, following on from last week's episode where we covered the basics of investment properties, we had a number of questions from you, our listeners, about the content we covered, as well as just, other information around investment properties. So in this episode today, we're going to be answering some of those common questions that you've asked about property investing and how can you make the most out of any future property investment that you may be looking to make. So as I mentioned last week, investing in real estate can be a really great way to build your wealth and basically generate passive income, which is the main thing that a lot of people are aiming for at the moment. So it's important to understand that before you make any investments, especially property-related investments, that there are market risks and external risk factors that you need to take into account. So just always do your homework, and let's get into today's episode.
Welcome to More Than Money with your host, Ross Murray. This episode of More Than Money is brought to you by More Time Financial, a financial planning company who are on a mission to help young Australians make smarter decisions with money by providing real-life financial advice, coaching, and financial education.
All right, so the first question came in from John. John asked, what are some good ways to get started in property investing? Thanks for the question, John. So as I mentioned last week, there's something called a REIT, so a real estate investment trust. And that is a group or a collection of properties that you can invest in as a retail investor that gives you a share in a property fund. And if we're looking at a way of getting into property without having to put down $50,000, $100,000, $200,000 and once you pay for all the fees and everything, this is a good way to start on a property investment journey if you're not sure of what you can afford or what the options are. But the reason I say this is because it gives you an insight into how property funds work, or how does property work in general. And it lets you see, okay, what does it look like on a residential side? What does it look like on a commercial side, retail side? And because you're investing in a number of properties, so it's kind of like a micro investment platform where you get to see lots of different investments only by putting a small amount in. This gives you an insight that gets to see how properties work. Now, if we're thinking about, okay, you're going to get into property and you want to buy a property on your own. Now, obviously that's a much larger commitment because we're talking in the tens of thousands of dollars rather than the hundreds of dollars if we just buying into like a managed fund, a REIT managed fund or something like that. But if we're thinking about buying into a property on your own, then the number one thing I'd be suggesting is doing your research. So researching how do property investments actually work. So what are you getting into? What is the return that we can expect? And this is a thing that I find that a lot of people get caught up on, is they don't realize what is a positively geared property or a negatively geared property, which we've covered last week. But just because you own an investment property doesn't mean that it solves all your problems. There are a number of things that come up as well that, okay, if it is a negatively geared property, that means you're going to be chipping in, putting extra money in. So once you understand how properties work, then it's looking at, okay, what is my budget and what are my finance options? And this is something that I find a lot of people, when they come to me and they say, hey, do you think it's a good time to get into property? Is the property market good, bad? What's happening in the property market or the share market, whatever it is? And we have that conversation, so are you looking? Like, I'm always looking, I'm always on realestate.com. Or can you afford to buy right now? It's like, well, no, I can't because I've just started a new job or I don't have enough money or whatever. So then the answer is no, it's not a good time for you to buy. It's not a good time. The property market's not good for you right now. regardless of if it's good for everyone else or what's happening on a broader scale. If you can't afford to buy, or you're not ready to buy, or you're not looking to buy, then it's not a good time, regardless of what else is happening. So understand your budget, understand your finance options, so you're prepared, you're putting your best foot forward. You go to a mortgage broker and say, hey, this is what I want to do, or you go and speak to someone like myself, a financial advisor, and we can help to put together, obviously, a bit of a strategy. But if you're looking at doing this on your own, it's getting those things in line to say, okay, now I'm ready. Now it's a matter of finding a property and understanding what you get involved with. So are you looking to buy a growth property? Are you looking to buy an income property, so a positive income property? What are we looking at doing? Is this we're going to buy one property? Are we going to buy 2, 3, 4 properties in the future? Now, if you're just getting started, these kind of questions can be a little bit daunting, but it's just trying to think through what the plan is going forward, because we find that people just think, okay, I'm just going to buy a investment property and that's it. It's not that. Unfortunately, property is simple, but it's not super simple. It's not that simple. So it's understanding what the plan is, understanding what your options are, doing your homework, doing your research, and then just start getting out there. So start going to open homes, start going to auctions, start talking to real estate agents. Being careful when you do that, but just building up your knowledge so then you know what your options are. Because all too often we find that people just commit to buying this one property, they put down $50,000 or $100,000 without doing enough research, enough homework. So they might spend 2 weeks analysing which phone they should buy, which only costs $1,000, but then they might just jump into the first property that they can see, or the first property that they get accepted on their offer gets accepted on, and it might not be the most suitable property for them. So that is what I would be suggesting as a way to get started in property investing. Thanks for the question, John. All right, next question comes in from Sarah. Sarah asks, how can I tell if a property is a good investment? Thanks for the question, Sarah. So a good property investment is, or just take one step back, a good investment, regardless if it's property, shares, or a business, is something that gets you closer to your investment or financial goals. Now, the thing that I find a lot of people get caught up on when it comes to property, especially property investment, is they start making emotional decisions. They think of it like the property that they live in, either whether you're renting or you own. And this is a trap that I find that so many people fall into because they get emotionally attached to this property, and they're not thinking of it like a business. They're not thinking of it like an investment. They're thinking of it of a house that they would want to live in, or they want to do the things to it, or they're like, okay, well, this is a nice looking house versus this isn't a nice looking house. And while we always want to have nice looking things and nice looking investment properties, whether it looks nice or not is secondary to whether it makes money or not. So that's the thing of, okay, well, is this property one, going to get me closer to my goals, or is property two going to get closer to my goals? So it's important, as we've spoken about time and time again, we need to understand what those goals are, because if we don't know what those goals are in terms of investments or financial goals, then we can't answer the question of, is this a good investment? Because it's a good investment for who? It's a good investment for what? So it's understanding what that is, firstly, what that goal is, and then a good investment is determined of, is it going to get me closer or further away from my goals? So it's understanding, okay, if the goal is investment income, we want as much income as possible, and we're not too worried if we get capital growth, so that's the increase in property value. If we get that, fantastic, but if that's the secondary goal to income, then we're going to be looking at very different properties versus if our goal is purely growth focused and income is the secondary goal. So it's understanding what those are, and then different properties are going to suit those different goals. Then it's looking at saying, okay, what is the potential of this property? So am I buying it that I want to get a return on my investment today, and if it doesn't give me a good return in the next 12 months, it's not going to work? Or is it a buy and hold strategy where I'm buying this property today, but it's probably not going to do very well for the next 2 years based on whatever factors we consider, but in 5-10 years time it might be really good? So that's where that time frame comes into it. So not only do we know our short-term goals, we also understand our long-term goals, and how does that play into it? Because depending on where you're looking at buying, in 5-10 years time, it may be a fantastic investment property, but today you're buying in the worst suburb and everyone's telling you not to buy there, but you can pick up a bargain and get that future growth. So it's understanding those factors as well when it comes to saying, it's not so clear of oh, that's a bad investment or that's a good investment, because we need to understand those goals. Also looking at what is the the potential of the property. So as I mentioned, like the capital growth of the area, but looking at what you could potentially do to it. So it's understanding, okay, well, what could I rent this property for? Let's take the assumption that we're looking for income. We want to try and invest for income. So it's looking at, okay, well, if we had a rental appraisal, so usually when you go and buy a property, they'll give you, if they're good agents, they'll tell you what it's either currently renting for, if it's rented, if it's an investment property for someone else, what it's rented for, what's the rental potential. So it's always important to get a rental appraisal of, okay, if I bought this property, and again, we've got our investment hat on, we're thinking purely on investment basis, we're not getting emotionally attached to the property. Thinking about, okay, what could I rent this property for once I buy it? So it's getting a rental appraisal either from the selling agent or getting another agent in there to say, okay, this is the property. It's looking at properties around the area or in the building, if it's an apartment complex, of what are other people renting it for. Because if they're telling you it's rented for $400 a week, but everyone else is only renting it for $250 or $300 or $700, whatever it is, then you can start to see there's some discrepancies. So it's understanding, okay, what could I potentially rent it for? And right now, without doing any work, and then trying to understand or trying to do your research of seeing, okay, what else is going in the area for a similar property that's maybe been improved or maybe been renovated. So if you look at buying a property that needs a new bathroom, needs a new kitchen, and they're telling you can rent it for $500 a week, but if you spent $20,000, $30,000, $40,000 on it to renovate it, doing the bathrooms, kitchens, all that kind of stuff, that means you can potentially rent it for $750. Then that's a really good way to turn a maybe not so great investment into a good investment. And that's one of the benefits of property, is that you can manipulate it or improve it in your favor, whereas the stocks and shares you really don't have much input involved in that process. So it's not so clear in terms of saying, okay, what makes a good investment or a bad investment, because you need to understand those goals. But those are the things that I would take into consideration when looking at a property. And again, if it gets you closer towards your goals, whatever those are, then I would say that's a good investment. If it takes you further away or doesn't help you reach your goals, then I'd say that is a bad investment. So hopefully that is helpful. Next question comes in from Mike. Mike asks, what are some risks to consider when investing in property? So Mike, we did cover a few of these questions, or risks, I guess, last week, but to answer your question in a bit more detail, there are a lot of risks, unfortunately, when it comes to property. Even though it is a very simple thing to understand, you buy a property, you rent it out, people pay rent, happy days. Unfortunately, it's not that simple. So the couple of things to think about is, again, assuming we're just renting it out straight away, you buy it, you rent it out straight away. There's no living in it. There could be issues getting renters. Now, that might not sound realistic right now, given in most capital cities of Australia, the rental market is crazy. There's obviously a couple of hundred people going to open homes and things like that. So right now that might not be an issue, but there has been periods of time in the past where investment property owners have had issues getting tenants. So that is something to think about, where yes, I think that for the next period of time, it's going to be a constant basis of there's going to be not enough properties for people to rent, depending on where you're buying. So capital cities, I think that's going to be the case. Other places, regional towns and things, that's not always as favourable for the property owners. So it's thinking about, okay, well, what does it look like if I can only get this place rented for 6 or 9 months of the year? So I'm basing my plans, I'm basing my financial plan and numbers on renting for $500 a week, 52 weeks of the year. What if for 3 months of the year, I can't get a renter? What if I can only sign someone for 6 months and then they don't renew, they move out, and then it's empty for 2 months? Can I afford to cover that shortfall? So that's something to think about. The risks are the property maintenance costs. So this is one that I find that far too many people don't budget for, or don't budget enough for, when it comes to doing the numbers and running the cash flow forecasts on their property, is the unexpected repairs, unexpected maintenance costs, the damaging of the property. So it's always important to have insurances, but if you have renters in there and they damage the property, so sometimes we've had people in the past be up for $5,000, $10,000 out of pocket to repair their property. Obviously the insurance has covered some of it, but not all of it. So getting it ready for the next tenant. So either they kicked them out or they left and they had to spend $5,000, $10,000 to get the property back up to scratch. The other issue and risk we run into is tenants not leaving. So this is something we dealt with a little while ago with a client, where the tenants just wouldn't leave. And depending on which state you are in, there are different rules for tenants' rights and owners' rights. And at a very, very high level, they generally favour the tenant because they don't want to obviously just kick people out on the street. But generally speaking, the rules are in favour of the tenant. So in this case, they wouldn't move out. They had to go to court, had to pay legal fees, had to go through a whole process to finally get them evicted. And I think it took a 3-month process. So it was 3 months of just a headache of trying to deal with getting these bad tenants out of the property. So that's something to think about. The other one is if you are buying in an apartment complex or a body corporate situation, is the unexpected body corporate cost. So we had a client, they bought an investment property, 3 months, 6 months later, they were up for $10,000 out of pocket because they decided to renovate the roof of the apartment complex that he was living in. So the other one is I guess in the same lines of the unexpected repairs and maintenance costs, is if you are buying an apartment complex and there's a body corporate situation, there could be body corporate expenses that you have to pay for. So we had a client that bought a property and 6 months later, he was up for $10,000 to repair the roof of the apartment complex that he was living in. Obviously didn't know that was the case, and that's a risk to think about. Similar to the risk of not being able to find a tenant is market could decrease. So the property market is fluctuates all the time, but that could go through a period of time where it decreases, and that could impact the lending capacity of your next investment property purchase. So if you're buying one property with the view of buying another one, if the market changes, the equity that you can extract from property number one that you just bought might impact the future borrowing capacity of property number two. The other one, which we're going through right now actually, is the interest rate increases. So again, assuming that you've borrowed money to buy a property like most people have, if interest rates increased and we hadn't budgeted for it, we hadn't forecasted for those increases, then that starts to eat into the cash flow. So you maybe experience either a neutrally geared property or a positively geared property where you're making money, but with interest rate increases, that obviously means it's eating into that profit, or into that cash flow, and you might be in a result where it goes to negative and you have to start chipping money in to cover the shortfall. So those are just a handful of risks to think about when it comes to investing in property. Next question comes in from Emily. Emily asks, what are the tax benefits of investing in property? Thanks for the question, Emily. So, a couple of things to think about, and I'll try my best to explain it because it can get a little bit complicated when it comes to tax and property. But in Australia, there are a number of tax deductions available for property investors. And the key thing to think about here is that property investors versus a house that you live in. So we're just talking about property investment. If you live in the property for 6 months of the year and then you rent it out or you Airbnb it gets really, really messy. So for argument's sake for today, we're going to assume that you have a house that you live in or you're renting, and then you have a house that you, as an investment property, it's 100% of the time investment property. You don't rent it out on Airbnb, you don't live in it part-time, it's not a spare bedroom, anything like that. It's purely investment property, 100% of the time, 52 weeks of the year. So I hope get that out of the way. But the number of tax deductions and tax benefits that are available is the ability to claim the deductions related to that property. So this might be the interest. So again, assuming you have a mortgage, the interest on that loan that is attached to that investment property is deductible. Property management fees, depreciation on the property, number of things help to reduce that taxable income. So again, just a quick summary, we have the rental income. So let's assume we're making $500 a week in rental income. Then you're able to deduct all of those expenses, interest, property management fees, depreciation, any other running costs related to that property. Then it's the net income that you have to pay tax on. If we have what's called a negatively geared property, so we're not making money on the property, so you're receiving $500 a week in rental income, but it's costing you in expenses of $700 a week. We have a $200 a week shortfall. That means your property is negatively geared. That means the previous example, we're making money. In this case, we're losing money. So that loss, that taxable loss, can be used to reduce your taxable income. So if we have your salary income of $100,000 and then we have a investment loss on your property, we can use some of that to deduct and reduce your taxable income. So hopefully that makes sense. There is a number of other tax benefits that when it comes to property, it can get quite confusing. So anything to do with tax, if you have any questions at all, it's really important that you speak to your tax professional, speak to your financial advisor to determine exactly what deductions are eligible for you. As I mentioned, when you are thinking about renting out a portion of your property, living in it for half the year and then renting it out, Airbnb, all that kind of stuff can get really confusing. So depending on your exact circumstances, it's always a good idea to chat to a tax professional or a financial advisor when it comes to those tax benefits. All right, the next question comes in from Jessica. Jessica asks, what are some tips for successful property investing? All right, so Jessica, the couple of things I think about here is, as I mentioned earlier, is doing your research, doing your homework, and understanding property, number one. Understanding exactly how it works, determining your budget, your finance options, what you can actually borrow, focusing on the cash flow at all times. So this is something that I find that a lot of people neglect to worry about, is looking at the cash flow and understanding how different market conditions can impact your cash flow. So we got to think of property, investing in property like a business. You are a business owner, your business is property investing. So we need to think of it like a business that sits on one side of your assets, your income. You have your income that you earn, and then you have your business on the side. So if you think of it like a business where you aren't, when you aren't emotionally invested in this business, you can treat it like a business. You can treat it like a money-making machine. That is a really good way to make or start being more successful when it comes to property. Staying up to date with what's happening in the market, so understanding what impact, as I mentioned, what impact interest rates will have on your ability to borrow money and ability to service your loan. What's happening in the broader rental market? So is the rental demand increasing where your property is? Is it decreasing? What's happening with other properties in your area? Just staying up to date with a few things is a really good idea. So while property investment can be one of the best ways to produce passive income, if you want to be more successful when it comes to property investment, doing these extra little steps can help a lot. Having multiple investment properties is a good idea. So diversifying your portfolio across maybe having a house, having an investment unit in different states, different suburbs is really a good idea as well. So it's diversifying your risk. So if one area in Australia, let's say Brisbane for instance, if that starts to decrease, or Melbourne starts to decrease, and you've got all your properties in that one suburb, in that state or that one suburb, that can be disastrous as well. So I find that all too often when people think about investing in property, again, thinking about the example of getting emotionally attached, they like to be able to go and see and touch the property. So they usually buy investment properties in the suburb that they live in or very close to. Not too often do I find people buy investment properties in other states and suburbs that they can't easily access, because it's just that sense of comfort. And on that same train of thought is what I find far too often when it comes to investing in property, people underestimate how many properties they need to be financially successful. Now, again, depending on what those goals are for you and what you want out of this investment property portfolio, but we find when we start talking to people, they're like, oh, I want to make $100,000 a year in passive income from property. Great, awesome goal to have. And they're like, I'm just going to go and buy one or two properties. It's like, well, have you actually done the numbers of what that means? So what two properties would you need to buy to give you $100,000 a year in net passive income? That is something that I usually find people don't do those calculations. They don't think through that step. It just sounds really nice of, oh, I want to make $100,000 a year in passive income from property. Okay, great. What does that mean? Does that mean, can we do it for two properties? What do those two properties need to be worth? One, what do those two properties need to be rented for? Two, and what are the expenses? What's the actual net income? More than likely, we're looking at 3 or 4 properties. So we find that most people go out and buy their one property to live in, and they buy a second property, if they can, as an investment property. At a stretch, we find that some people have 2 investment properties and a house they live in, which would be great, but not too many people have 3 or 4 properties. So we find that if you are wanting to reach that goal, we need to look closely, okay, what does it actually mean to have $100,000 a year in net passive income from property? Is that 2, 3, 4? Is that 5 properties? What is actually needed to do that? So we find that most people stop at 1 or 2 investment properties. which is still a fantastic goal, still a fantastic achievement, but it's not going to get them to that goal if that goal is hypothetically $100,000. So those are a couple of things that I'd be thinking about. The other thing, which I guess kind of falls in the same track, going that extra step, is when it comes to property, it's very, very simple. Like it's a very simple investment to understand. Most people have, as I've mentioned a number of times, either own a property or have experience being a renter, so they understand that transaction. But if you go out and buy a property, or buy a lot of good, what we call investment grade property, or what we call investment grade properties, you rent them out, you hold them for 20, 30 years, they're in a good area, they're a good property, you're going to be successful. Like there's not many circumstances. Yes, there might be ups and downs along the way, but if you can get through 20, 30 years of holding those properties in good properties, you're going to be successful. It's simple, it's pretty boring, but it definitely works. There are, however, ways of going the extra step. As I mentioned a few things already, but the other one is like house hacking. Put in that extra work of, could you renovate the property? What can you rent it for now? What happens if you renovate it? What could you rent it for then? Are you willing to put in the extra work of renting it as an Airbnb? So making it a short-term holiday rental. Those extra steps can make those properties more successful. So if you had a property that you could rent for $500 a week to a long-term tenant, you could potentially put it on Airbnb for $250 or $300 a night. Then we start to see, okay, well, yes, it's more work than just the boring long-term tenant example, but you could potentially become more successful. So those are the things that I'll be thinking about when it comes to property. All right, next question came in from David. David asks, how do I find good investment properties? Thanks for the question, David. So the things I would be thinking about when it comes to finding a good investment property is first understanding what makes a good investment property. So assuming we know that based on a few of the questions we've answered already, but then you want to start doing your own research. So if you're doing it yourself, then it's a matter of going out and finding those properties. Like as simple as that sounds, it's doing the hard work, it's speaking to people, it's getting out and trying your best to find those properties that are ideally undervalued or some sort of deal in a growing area, growing suburb, growing market. That would be fantastic. The other way, depending on whether you have more time on your hands or money, two ways to think about it. So if you've got lots of time on your hands and not too much budget to be able to hire someone, then you can go and do your own. If you've got no time on your hands but a lot of budget to help get someone to help you, then you can go and chat to someone like a buyer's agent. So a buyer's agent is a real estate agent, but they work for the buyer versus the seller, and they can help doing the searching process. So you could go to them and say, hey, I'm looking for a property that's going to give me $500 a week in income. It's this budget, etc., etc. This is what I'm looking for. Take it to them, and they go and find those properties for you. Now, the benefit of using someone like a buyer's agent is that they have access to the network of all the seller's agents in most suburbs, that anytime a seller's agent meets with someone to put a property on the market, they're going to call all the buyer's agents and say, hey, I've just listed this property at 123 Fake Street. This is what they're wanting. Do you have any buyers that are interested? So far too often, the people that can afford buyer's agents are getting access to these, or getting potential access to these properties before it even gets on the market. So you've got to understand what game you're playing when you're up against people like this. So you're up against buyer's agents, you're up against people that can afford buyer's agents if you can't. And so you're going to do your own research, whereas they're getting access to these properties before it even hits the market. So it's sometimes an unfair advantage that they play, but unfortunately that's the world that they play in. So again, thinking of doing your own research, it's looking for properties that, again, is it an income property? It's doing that research. Like I'm not sure if there's any other way to approach it. It's also looking for what is the next kind of growth suburb. So it's not only looking at what is the hottest property suburb right now, it's looking at, okay, what are the long-term trends of that area? So if you looked at whatever suburb, whatever state you live in, it's looking at, okay, what is the trajectory? Are people moving away from the CBD? Are they trying to get closer and closer to the CBD? What's happening? Where's local schools getting put in place? What makes this suburb desirable? So it's thinking about those different opportunities of, okay, yes, there's these places that are on the market right now that everyone can see, but there's also these extra places or extra suburbs that you might be thinking might make a good property market or good investment properties in the future. All right, so the next question came in from Karen. Karen asked, what is a property investment trust or a REIT? So this is something I mentioned a little bit earlier. So a REIT, real estate investment trust, is something, it's similar to a share. Well, it basically is a share, and it lets you invest in a diversified portfolio of real estate properties. So rather than the typical example of me going out and buying one investment property just for myself, I own it 100%. It is, let's say, 100 of your closest friends all getting together and say, look, instead of you putting $100,000 in, if all of us put in $100,000 in, or all of us putting $10,000 in this example, and now we've got this group, this amount of money that we go out and buy, not one property, but go and buy 10 properties. We all own a portion of it as a percentage, but that's what these big companies have done, is that they own all these properties. They put together a property portfolio and say, this is what we're invested in, these are the properties that we have, and you as a retail investor can go ahead and say, I want to buy into ABC REIT, and you have a small percentage in a property portfolio. Similar to shares and how shares work, you get a return, so the rental income, net income from that portfolio company. If there's any profits, then you get profits back on a quarterly or yearly basis in percentage of your ownership of that portfolio. The other good thing about a REIT is that it does also offer, which I mentioned, which answered earlier, is that it gives you an opportunity to invest in different types of real estate as well. So different REITs have different holdings or different weightings in different types of property. So it might be like office buildings, retail, shopping centers, apartments, different types of investments or different investment properties. So rather than you just going out and buying one unit, you can get access to lots of different investments. So that is something, I'll put some bit more information about REITs in the description below, because it is something that has been coming up more and more. All right, so the final question on today's episode is from Maria. Maria asked, what are the downsides of investing in property, or are there any downsides investing in property? So the short answer to that question, Maria, is yes, there are downsides. Just like any investment, which we mentioned time and time again, there's no such thing as a risk-free investment. So, which means there are downsides as well. So a couple of downsides to think about, and not shitting on investment properties in this episode at all, but something to think about is the investment properties going down. So not too often that people think of, oh, this property value could go down, because we've always been told that property always goes up, which is incorrect. If you are in a growing suburb, growing area, growing market, and it's continually becoming more and more popular and more people will live there, then it's unlikely that it will go down in the short term or in the long term, but it does still decrease in value potentially. So depending on the area, depending on the location, you just have to do a quick Google search of the mining booms a couple of years ago. So around I think it was 2010, 2012, the mining booms in Australia, what happened to the property markets in certain mining towns. So that's something to think about, which kind of leads to that next one of buying a bad investment property. So if you buy a poor performing investment property, that one, you can't rent out the tenants, it goes vacant for 6 or 12 months, therefore you're having to pay the renting costs and to keep the upkeep of that property. So that's something to think about. As I mentioned earlier, unexpected repairs and maintenance, that can be quite expensive depending on if you've got a small unit, 1 or 2 bedroom unit, the upkeep on something like that might not be large, but if you've got a property, a 4 or 5 bedroom property that you're renting out, then the upkeep and the maintenance between tenants that you're responsible for as the owner. There's some things that the tenants are responsible for, but if you're responsible for it, then that's to think about as well. The next one is property investments, or property in general, don't offer the same level of what's called liquidity. So liquidity is access to money. So if you have a share portfolio and you need access to it for whatever reason, you have $20,000 and you want to get access to it, you can pretty much do that within 3 to 5 days. You can sell your shares and get the money deposited in your bank account. When it comes to property and property investment, if you're in a position that you're looking to sell or you need to sell, you can't just go ahead and sell like a portion of the property. So the example is you can't just go and sell a door or sell one bedroom. You need to either sell the whole property or half it or whatever to someone else if you know them. But you can't just go and access that money really quickly. So the liquidity is an issue. So if you need access to money, it's not something you can sell really quickly. And then the other one is, I guess, in the same thought process as expenses, but it's just knowing and understanding all those expenses. So it's something that I find a lot of people don't fully understand the expenses that they're responsible for, like the insurances, dealing with tenants, dealing with agents, dealing with people ruining your property. All those things can potentially have an impact on property as well. So those are a couple of things that I would be thinking about as a potential downside of investing in property. I hope that's helpful. All right, so that wraps up today's episode. We hope you found that helpful and given you a bit of a better insight into understanding the opportunities, risks, and challenges involved in real estate investing. Always remember, as I mentioned a few times, do your own research, consider your budget, consider your long-term goals and plans and your risk tolerance, understand what your borrowing options are, so talk to a mortgage broker about what you can potentially borrow when it comes to buying investment property, talk to your financial planner, talk to your tax accountant. Real estate agents can be sometimes a little bit tricky to deal with, but they are also a good source of information about what the potential opportunities are with different types of properties. With careful planning and a long-term strategy, property investing can be a great way to build your wealth and provide you with a great source of passive income. So it's always a good idea to consider the option of looking at property in your investment portfolio. Thanks again for listening, and we hope you have a successful investment journey. We'll see you next week, where we'll be rounding out the final chapter in our Growing Your Wealth plan by covering all things you need to know about superannuation. Hope you have a great week.